The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Optimism on trade, confidence in the Fed, dependency on tech earnings. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. You take a look at where we stand with just an hour to go, hitting session highs on the S&P 500 on this Monday morning, up by more than 1%. A lot of that coming down to optimism over trade. Also, a lot of optimism flowing through big tech right now. The Nasdaq 100 higher by 1.7%. We have a mega week ahead when it comes to tech earnings, which of course we will get to. It's the small caps, though, that are underperforming. And I thought that was interesting. The Russell 2000 only up by about 0.3%, looking really pedestrian compared to what we're seeing in some of the large caps this morning. And then you have the 10-year yield. Well behaved once again, similar to what we saw on Friday. Pretty much no movement here. The 10-year Treasury yield just below 4%, Romaine.
Yeah, but we go back to the top line on your screen there. Quite breathtaking. 68.63 and change on the S&P 500. Strongest three-day rally for U.S. equities since mid-May. This as earnings season actually proves to be stronger than expected so far. JP Morgan strategists say 66% of companies out there have reported double beats. That means sales and profit, up from 51%. And that was before big tech had a chance to report. That changes this week in a big way, with 5 of the Mag 7 on tap, including Apple and Alphabet, a duo that together have accounted for almost 40% of the S&P's point gain since the last earnings season 3 months ago.
We had a tremendous amount of earnings enthusiasm and optimism in that last reporting season. It got about as good as it tends to get, and now it's coming back down to earth. It's going to be, I think, make or break in terms of what the tech companies do this week. The tech sector has been doing an enormous amount of heavy lifting.
The other heavy lifting out there for this rally, at least as of late, is optimism around the trade front. U.S. and Chinese negotiators handshaking on issues related to tariffs, shipping fees, and export controls. That actually pushes U.S. shipping stocks like Zim and Matson to their biggest intraday jump in weeks, while precious metals and rare earth stocks giving back some of the gains from the trade tension-fueled rally of September and October. EM assets also getting a bid, partly on the trade front, partly on the potential for Fed cuts this Wednesday, and partly on that market-friendly outcome to midterm elections in Argentina. The MSCI Emerging Market Index hitting its highest since 2021, while the U.S.-listed ETF dedicated to Argentina stocks having its best day ever.
Absolutely. A consequential weekend when it comes to global politics. But let's go back to the U.S. earnings front, because as Romaine said, a heavy week ahead when it comes to the Magnificent Seven finally taking the stage. So I thought we'd take a look at what the expectations are when you think about profit growth. This graph coming from Bloomberg Intelligence showing that when it comes to Magnificent Seven profit growth, about 14.3% expected in the third quarter of 2025, which is double digits. But compare that to recent histories. That would actually be the slowest profit growth since the first quarter of 2023. And just a reminder of where we were when it comes to the final quarters of 2023 to the beginning of 2024. We were boasting more than 50%. It has been a slow slope downwards since then, Romaine. And now, again, expected this round 14.3%.
All right, well, kicking us off to the close, and quite frankly, kicking us off to an incredibly busy week for big tech earnings, is John Belton, portfolio manager and managing director for growth portfolios over at the Gabelli Funds. And John, I want to just first, let's start off with the elephant in the room, and that is just the overall discussion that everyone's going to have about AI spending, whether that spending continues. Based on the names that you track, based on the names that you're invested in, John, you expect that spending to continue?
Yeah, absolutely, Romaine. Nice to be with you virtually. So I mean, this is a investment cycle that still, to me, seems in early innings. I will say the magnitude of revisions to spending expectations that we've seen over the last couple of quarters has been, frankly, insane. And I think we're probably entering a period where the spending is going to continue to grow, but the surprised versus expectations, I think, compresses a little bit from here. That's kind of how I'd frame my expectations for this week.
There's been a lot of talk when we talk about the AI spend, John. We've seen the benefit on top line revenue growth, but there have been a lot more questions about whether we're going to start to actually see that show up more so on the bottom line. And I do just want to bring a headline that came to our attention right before the show. This involves involving Amazon, a report by Reuters saying that the company is going to cut about 10% of its corporate staff, about 30,000 workers. And we don't have a lot of details, John, on exactly why. But it gets to this question right now as to whether these companies that are splashing so much cash on all of these, I guess, AI future, if you will, John, do actually have a cost structure in place that's commensurate with it.
Yeah, I mean, so I did see that headline. I haven't really dug into the story yet. Not sure exactly which workers that's impacting, whether it's actually just corporate workers or if there's warehouse workers as well. But I think Amazon's a really interesting example of a large tech company that is both distributing AI infrastructure to customers through AWS, but is also using AI to make their own operations more profitable, both on the e-commerce side, in terms of what they're doing with advertising, but more interestingly, what they're doing with automation across the fulfillment center network. I think between last earnings and now, they disclosed that they've got over 1 million robots that are now live and operational in their fulfillment center network. So I think that's just like a super interesting use case for AI that they're doing. And so I guess the short way to answer your question is, yeah, I do think that these companies that are spending the most on AI are already seeing enormous benefits, both on the revenue generation side and in the P&L and the cost side.
Well, when it comes to these specific reported layoffs, it's Reuters reporting that it is corporate jobs, 30,000 corporate jobs. We'll continue to follow that story. But when it comes to Amazon overall, of course, those earnings will be closely watched because Amazon, as you point out in your notes, has been one of the underperformers year to date. When you take a look at the share performance, just slightly positive in 2025. And I wonder where they stand when it comes to cloud business overall, the competitive landscape there, because you think about the AWS outage, certainly reputationally that was a black mark, but I wonder, how it fits into the broader story about where Amazon stands right now.
Right. Well, I do think Amazon, you could make the argument, is the most hated of the Mag 7 right now by investors. And I think the simple investment strategy that has worked over the last couple of years is gravitate towards the most hated Mag 7 name. That's obviously oversimplifying things, but Google's an example of a company where 3 months ago, or Alphabet, I should say, is an example of a company where 3 months ago, investors really doubted the AI strategy, felt like they were falling behind in AI. Fast forward 3 months, and the narrative is completely flipped. I don't think it's crazy to think that a similar dynamic could happen with Amazon. What we're going to need to see this week, the market wants AWS growth to accelerate. They want Amazon to talk to further acceleration ahead in AWS. I'm not sure we're going to get that, but they should have a big tailwind starting to come through AWS from Anthropic as a huge AI customer that is really starting to see their business take off.
John, it's really interesting that you make that point that, gravitate towards the most hated names when it comes to big tech. Certainly when it comes to Alphabet, that has been the case. I wonder if that logic could apply to Apple. You think about Apple, also that same narrative haunting the company, that they've fallen behind when it comes to AI, and the stock has certainly underperformed so far.
Yeah, it stands alone across the big tech group as a company that is not spending, hundreds of billions of dollars or at least tens of billions of dollars on, the AI infrastructure build out. They're taking a more capital light approach. They're framing themselves as being a distributor of AI to their massive iPhone and devices user base. And for Apple, I think what we saw last quarter was a really big unexpected acceleration in iPhone sales. And I think there's a possibility that that is sort of the start of a big iPhone replacement cycle. Users who bought phones 3-4 years ago during COVID that are now replacing their devices. And if we get another big iPhone quarter this week, I think the narrative is going to be for Apple, they're entering a replacement cycle, and you've got these new iPhone 17 products launching with better AI capabilities, better AI-enabled hardware.
Yeah.
And you've got this potential upgrade cycle coming from that.
Hey, John, only got about 30 seconds left. I do want to get your thoughts on Meta.
Mm-hmm. Meta, it's amazing to me what valuation that stock trades at, given the fundamental profile, a business that's still growing top line mid-20s at the scale they're operating at. I think they've got a really interesting AI strategy there. Probably of any company, the one that's getting the most benefit in their core business from AI today. So I expect another really strong quarter from Meta, strong guidance, and I think that remains a pretty good holding.
John Belton over at the Gabelli Funds. A nice preview of some of the big earnings we get this week out of Apple, Amazon, Microsoft, and Meta as we count you down to the close here on this Monday afternoon. We also turn our attention to what's been going on in crypto, Bitcoin getting its mojo back, and cash is calling. Anthony Pompliano, founder and CEO of Professional Capital Management, he's going to break down whether the latest rally has room to run.
And it's not just crypto heating up, so is geopolitics. Richard Haass, he is President Emeritus at the Council on Foreign Relations, joins us to discuss if he thinks sparks will fly at the upcoming Trump-Xi summit.
And a lot of headlines going on right now in the chip space. Qualcomm, AMD, everything AI. Bernstein, Stacy, Rasgon is going to discuss how AI demand is fueling the semiconductor surge. Stick with us. This is The Close on Bloomberg.
Well, Citigroup, the latest traditional finance giant to tap into the crypto craze, teaming up with Coinbase to expand digital asset payments to institutional clients. Seems like the catalysts are just adding up here when it comes to crypto, with the Trump administration also floating a plan late last week to swap some U.S. gold reserves for Bitcoin. Joining us now is Anthony Pompliano. He is founder and CEO of Professional Capital Management. Anthony, great to see you in person.
Absolutely. Thanks for having me.
So let's start broad here and just what is going on with the price of Bitcoin right now, because it seems like a few weeks ago the debasement narrative had really taken off, especially when you paired that with the twin rally that we were seeing with gold. It seems like some of the shine is coming off of gold now, crypto continuing to regain some momentum here, and I just wonder what you think currently is the driver.
Well, for years now, I always look at gold. Gold's the fold back. It goes through the hole, it blocks somebody, and allows the running back to go score the touchdown. And Bitcoin's going to do exactly that, which is what it always does. It's about 100 days or so after gold runs, usually you see Bitcoin take off. And this rotation from gold into Bitcoin really is whenever investors feel like, hey, there's some uncertainty, there's some sort of issue that I need to pay attention to, they run to gold. That's what they've been trained to do for a very long period of time. But then once they realize, hey, wait a second, the world is not going to end, I actually want to drive outperformance. I want to drive a return. They rotate from gold into digital gold, and Bitcoin usually tends to outperform. And so gold's had a great year this year. I think the gold bug should get a lot of credit for investing in gold, holding gold. But I think that Bitcoin's still going to do what Bitcoin does, best performing asset over the last year or so, and I don't think that's going to slow down anytime soon.
Well, that gets kind of to something I wonder about when you take a look at these twin rallies, the fact that you have gold and Bitcoin, not only the price appreciation, but you take a look at the ETF flows as well. There are billions of dollars that have flown into both types of vehicles. And I just wonder if those two assets can live in harmony, or if Bitcoin really continues this rally, whether it's going to take some of that demand that would have been going into gold.
Well, I definitely think that gold has probably had its run for this year. My expectation is gold will probably go sideways or sell off into the end of the year, and Bitcoin will likely take some of those flows and kind of go up. One of the things I've changed my mind over the years is I used to think that Bitcoin was going to surpass gold, but it was going to do it somewhere sub $10 trillion market cap. And a big reason was it was going to demonetize gold. Instead, the exact opposite's happened. Gold has thrived, as has Bitcoin. And I think that we're going to continue to see that. I still think the digital version of these sound money principles will be a bigger market cap than the analog version. It'll just take some time to get there.
I am curious, too. Going back to this idea of the debasement trade, and I know there's a lot of speculation for why Bitcoin goes higher, but sort of the genesis of really the crypto industry overall was obviously a lot of concerns about our fiscal situation here in the United States and really around the world. Have you seen any potential that changes, meaning the fiscal situation gets better, or you think it's going to continue to get worse, and does that benefit crypto?
Well, what's interesting is people will say that Bitcoin has no ceiling because the dollar has no bottom. Right? And I think that there's kind of this belief that they're never going to stop printing money. Now, when Donald Trump came into office, I think there was a lot of talk and people got very excited, including myself, about, hey, could we actually get to a balanced budget? It's been 2 decades since we had one of those, and could we get there? Doge was a kind of a valiant effort. I think there's a lot of other things. What you start to realize is, one, we're addicted to the cheap money, we're addicted to the money printing, but also there are a lot of incentives at play that are not actually trying to get to a balanced budget. And so I think that people now kind of pivoted in their viewpoint. They believe that we're going to run the economy hot, we're going to try to grow our way out of it, and therefore the dollar is going to continue to have this accelerated debasement, and that's why you see gold and Bitcoin both doing pretty well.
You've been really involved in this industry for a while and really seen it grow from nothing to what it is today, which is sort of an identifiable asset class. It's on par with anything else. There's also a lot of companies that have gone public and taken advantage of that. You obviously have your own company. You're not public. When do you plan to go public, if at all?
Yeah, so we raised just over $750 million earlier this year. We've announced a business combination with Columbus Circle, and which is a SPAC, and we believe we'll be public later this year. That at least is the hope. And our goal is really to go and try to build a financial services firm that leverages Bitcoin as a foundation. Kind of think of it as a Bitcoin native financial services firm. You know, one of the things that's really interesting about traditional finance is people have not really innovated in terms of the structure of these financial services firms. They still build products and services. They give them out to customers and they drive profits. Well, their balance sheet is dollars and the profits are in dollars. Well, what if you start to build financial services and still serve a certain customer and solve their problem, but instead you think about it in terms of beating Bitcoin as a rate of return or a benchmark there. And so we think that Bitcoin as a rate of return is a really interesting way to think about investing your corporate kind of balance sheet.
All right, Pomp, we got to leave it there. Always thank you for taking time for us. Anthony Pompliano, founder and CEO of Professional Capital Management. When we come back, we're going to talk about that Keurig Dr. Pepper deal and, of course, the financing behind it. Stick with us. This is The Close on Bloomberg. Let's get right to our top calls. Big movers on the back of analyst recommendations. We start with Microsoft. Guggenheim, one of only two analysts with neutral ratings on the stock, upgrading today to buy ahead of the company's earnings on Wednesday. Guggenheim says Microsoft is, quote, set up to outperform for the rest of the year. The upgrade now means 99% of the analysts tracked by Bloomberg recommend buying the stock. That stock on a 7-day win streak. Next up, let's take a look at Booking Holdings. Truist upgrading to first class, raising the recommendation to buy. This ahead of the online travel company's results tomorrow. Truist forecasting several avenues of near and long-term earnings growth. That stock up for a second straight day. And finally, Five Below. JP Morgan betting big on the discount retailer, an upgrade to overweight and a bump in the price target to 186, with the analysts seeing Five Below becoming a, quote, one-stop shop for the holiday season, given their Halloween, Thanksgiving, and Christmas product offerings. Those shares up about 3% on the day to their highest level since 2024. Meanwhile, we want to stay in the consumer retail space and take a look at shares of Keurig Dr. Pepper. The shares at one point hitting their highest intraday level since March of 2020. This after boosting their full-year outlook and announcing a $7 billion investment to support that acquisition of J.D. Peet's. Joining us right now to discuss is Lauren Lieberman, Senior U.S. Equity Research Analyst at Barclays, who specializes in the beverages sector. All right, a big deal. I think there was some head scratching when the deal was first announced. Assuming this thing gets done, you think it's going to be accretive overall for both of the two entities once it's all done?
That's right. That's right. They've talked to it today. They finally formalized this. It'll be about 10% accretive to EPS going forward.
Is there a sense here when we talk about trends in terms of coffee drinking relative to, say, drinking soda and other things like that? I was always under the impression that both of those were businesses overall that were maybe a little bit weaker than what they used to be in the past.
Yeah, I mean, coffee is one of those categories that benefited, actually at-home coffee benefited significantly during COVID, right? We were all at home, we were drinking a lot of coffee. And so the correction from that has lasted a lot longer than I think people expected. And then you've got further challenges of people drinking things like energy drinks, right? There's substitutions, other ways to get your caffeine fix. So the category has definitely been a lot slower. It seems like it's trough, though.
I am curious to bring this conversation back to Keurig Dr. Pepper specifically. I mean, one of the reasons that you're seeing such a reaction in shares today is news that they're raising $7 billion from Apollo and KKR to help finance that acquisition that Romaine mentioned. I mean, you think about some of the concerns that were expressed when this deal was announced, concerns that basically Keurig Dr. Pepper was taking on too much debt and really boosting their leverage and raising that. I wonder, whether or not you feel a little bit better about that right now when you think about private equity getting involved.
Yeah, I mean, absolutely. And what we'd written about when the deal was announced and subsequently was the ultimate separation of assets, there being a global beverage company and a domestic beverage company, a global coffee company, makes sense. It makes more sense in the current structure today. It was the path to get there, and key to that path was a very surprising $18 billion spent to go out and acquire J.D. Peet's and the resulting leverage. So now we're going to have leverage, which will be, they're talking about at or below 4 times for the two entities once they're separated out versus something that would have been 5 to 5.5 times by our estimates before this announcement today.
Absolutely. And again, you can see the reaction in shares. It seems like Wall Street welcoming this move. I want to couch this conversation in the consumer, the health there, because caffeine, I think that might fall under the category of a consumer staple. It's something that a lot of people need. But even so, I mean, if people are being a little bit choosier and tightening up their wallets, how does that affect a company such as Keurig Dr. Pepper?
So, I mean, one thing that I've often thought about is that at-home coffee should be really defensive, right? The cost of making a cup of coffee at home, even if it's single serve versus a full pot, it's a lot less than going out to, you know, in a coffee store and getting your big latte and so on and so forth, right? So it should be a really defensive category. What we've seen, though, is that even when consumer wallets have been strained, it hasn't resulted in a surge of at-home, as we would have expected. So I do think some of it is the draw of these other categories. Some of it is the hangover from people going back to office, being more out and about, more socializing than I know it seems like a long time ago.
Yeah.
But it was a long recovery post-COVID.
Is Pete's, though, at least here in the U.S., are they benefiting from that? I mean, we've talked a lot on the show about some of the changes being made at Starbucks under their new CEO, and the idea, I think, kind of what you're getting at, that people want to hang out in these coffee shops in a way that the coffee shops haven't really let us, because they've kind of moved to these sort of, online ordering, takeout kind of business models.
Yeah.
Yeah.
So I'm not as familiar at this point with the Pete's business. I will say that KDP is talking about Pete's as being a really under-leveraged asset of the JDE Pete's. Mm-hmm. The thing we talk about most is just that for KDP, what this does on the coffee business, it gives you exposure to global coffee. It takes you away from exposure to just one format. Right now you can do the shops with Pete's, you can look at cold coffee. There's lots of different avenues for growth, and you're not just wedded to this one single serve system. But they absolutely talk about Pete's as an under-leveraged asset in an area of big opportunity.
I'm also curious, I mean, just again, looking at the industry overall here, the fact that, you are seeing these two combine into one company and then KDP is sort of spinning off into two. Would you expect more of that type of activity in this industry specifically?
Maybe, I mean, it's hard. It's hard, and we've certainly seen it. We've seen it in the food space. We've seen a number of these types of transactions. They've been less common in beverages and HPC, which is my area of expertise, if you will. Mm-hmm. But I think companies are getting more creative, and I think that when you're in a time of slower volume growth, and we've been in a time of slow volume growth, companies start getting creative, right? And they're looking for other ways to drive economic growth.
All right, so maybe we'll see some more creative
You don't drink
deals.
those energy drinks, do you?
Obviously not.
Okay, yeah.
Yeah, I stay away from them.
Yeah, my producer, she just slams those.
Yeah, it takes a certain type of stomach. Anyway, Lauren, great to spend some time with you. That is Lauren Lieberman.
I got a sensitive stomach, Katie.
Senior U.S. equity research analyst over at Barclays. Now, coming up, the countdown is on, just days away from Trump and Xi's highly anticipated meeting in Asia. We'll speak to Richard Haass, President Emeritus at the Council on Foreign Relations, next. This is The Close.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostic.
And I'm Katie Greifeld. We're looking at a big rally in the S&P 500 right now. A lot of anticipation and optimism that maybe we're going to get some good news when President Donald Trump and Chinese President Xi Jinping meet later this week.
Yeah, you're actually seeing EM stocks outperform today. Also, EM currencies outperforming the dollar. And a lot of that seems to be tied not only to some interesting developments with regards to Trump and Xi, that big meeting on Thursday, but some commentary by the president of Mexico and her relationship with Trump, comments by the president of Brazil and his relationship with Trump, and then, of course, an Argentina election. Midterm election that seemed to ratify the relationship between the U.S. and Argentina. So a lot going on, whereas Trump sort of makes it around the globe, Katie Greifeld.
Absolutely. Yeah. A lot of cross currents right now, but certainly it seems like the most urgent of them when it comes to what the market is focusing on is that China-U.S. relationship. And here to discuss, I'm pleased to say, we have Richard Haass. He is President Emeritus over at the Council on Foreign Relations. Fantastic to have you with us, Richard. So again, there's a lot of anticipation here. We heard from a Chinese official earlier that the two sides have reached a number of preliminary consensus agreements when it comes to a lot of different topics, including non-tariff measures. And I wonder, in your view, what would be good news coming out of this when it comes to a win that the Trump administration might need?
Yeah, I think Katie, all the background music is good. Both sides want to make progress. I think we're looking at more a ceasefire, if you will, than permanent peace between the United States and China. Maybe get something from China on rare earth minerals, United States and China come to some sort of finally an agreement on TikTok. Americans can resume some degree of soybean exports and perhaps other agricultural products to China. China might take steps to reduce the trade imbalance between our two countries, but essentially to quiet for a time, hopefully at least a year, maybe longer, all the friction, shall we say, in the U.S.-China economic relationship, which would also mean that China would not impose a ban on rare earths and we would not raise tariffs to the sky.
It's hard to imagine things being quiet for a year, especially over the last few months. That really has stretched out just how long that would feel. But you bring up soybeans, for example, and this is something that I've been thinking about and reading about, that a few folks have brought up the idea that basically we're trying to get back to where we were when it comes to the U.S.-China relationship, especially when it comes to soybeans. Now the goal, it seems to be, is to get China to start buying U.S. soybeans at the level that they were before Trump took his office for his second term. And I wonder, from where you're sitting, whether it looks like a similar situation to the one I described, that this is a fire that the U.S. started that they're trying to put out.
It'd be hard to go back to where things were before, but as you say, this was something in many ways, we started the tariff war. By the way, I'm not sure either country wanted to get to that point. United States instituted tariffs against a lot of countries. They held off responding. China, which sees itself as something of a peer, obviously has the history of concessions, retaliated. And I think this got a little bit out of hand, out of control, and got things to a place neither country necessarily sought, but that's where they ended. I think now, though, it would be hard to go back to the status quo ante on things like soybeans. China's entered into various contracts with other producers, particularly from Latin America. I don't know the duration or the scale of those contracts. My guess is, though, as a matter of goodwill, you'll see the resumption of some soybean exports from the United States to China. But I'd be surprised if it was, if you will, a return to where things stood a year ago.
I'm curious on that point too, Richard. There's been a lot of discussion about some of the deals that China's been making without the U.S., meaning with other countries out there, particularly in Asia and to a certain extent in Africa and Latin America. There's been discussion that this is part of a broader reordering by China of its trade relationships across the globe, given the tense relationships now that it's had with the U.S., let's face it, for really going back to the first Trump administration, so basically more than 8 years now.
Look, I generalize your point because I think it's a fair one. It's not just China. A lot of countries have looked at what the United States has done over the last 9 or so months and basically said the United States turns to tariffs now with great frequency. It's also very hard to predict with any confidence what the levels are going to be. Look at what's happened to Canada over the last few days as a case in point. So what I think you're seeing are countries, how would I put it, diversifying their economic portfolios away from the United States. I'm not talking about decoupling. I'm not talking about having no economic relationship with us, but again, diversifying so that they reduce their dependence on access, if you will, predictable access to the U.S. market. And I think that's not just China, but an awful lot of countries are either have moved or will move in that direction.
Do you see a fight right now under the surface, Richard, with regards to the sphere of influence that these two countries, the two largest economies in the world, are trying to take? And I ask that because there's been a lot going on in Latin America with the U.S. and Venezuela, the U.S. financial relationship with Argentina that I think has caused a lot of people to scratch their heads. And I am curious as to what you think the end game is.
I think you have to break it down for geopolitics and economics. The United States is far more involved in the Western Hemisphere than it's been, shall we say, in some time. And a lot of people, a lot of observers are wondering about whether that indicates that becomes the part of the world where we make a large geopolitical investment as we dial down Europe, the Middle East, and also Asia, which would give China more room, particularly in the Asia Pacific. Economically, my sense is we're going to be competitors there. I don't see either side, either country ceding Latin America or anywhere else. Again, the problem, I think, for the United States in some cases is that trading with us has become more complicated because of tariffs, because of demands that countries invest here and so forth. that I think in some ways we're creating some space and some opportunities for countries like China.
Well, when it comes to tariffs, we also heard today from Treasury Secretary Scott Bessent saying that President Trump's threat of 100% tariffs on Chinese goods is, quote, effectively off the table. So there had been the idea that when it comes to these very, very high tariff levels that are floated about, that they're basically bargaining chips, basically negotiating tools to bring the other side, China in this case, to the table. And I'm wondering if that is basically how we should view every threat of tariffs going forward.
I don't think so, because as you know, the baseline tariffs, when this administration began, they were 2 or 3%. Now they're up between 15 or to 20%. So the basic role of tariffs has jumped dramatically. Some of these situations, there might be bargaining. We've seen it with China, maybe to get them to be more forthcoming on rare earths. We'll see what happens with Brazil. We'll see what happens with Canada now. We'll see what happens with India. So yes, they may be bargaining tools, but essentially it's a form of economic warfare. And the question is, how do others retaliate? And again, I think economically, they're going to look to reduce their dependence on us. And it will also have a certain spillover into areas of geopolitics. It's very hard to tell a country, including a lot of the countries the president's going to be meeting with over the next couple of days, that we're strategic partners at the same time that we're introducing the reality or threat of high tariffs. Very hard to have it both ways.
All right, Richard, really appreciate you taking time for us. Richard Haass there, a lifetime of experience advising presidents and governments. Now, of course, the President Emeritus at the Council on Foreign Relations. When we come back, we're going to turn back to big tech and some big moves in the chip space, including Qualcomm spiking after an announcement that a suite of AI products and a new front for its NVIDIA rivalry. That's coming up next on The Close. This is Bloomberg. All right, time now for our stock of the hour. We're taking a look at shares of Qualcomm, up about 10%. This after announcing new AI chips and, more importantly, a customer for those AI chips, Saudi Arabia. Joining us right now to discuss is Bloomberg's Norah Mulinda. And Norah, this has been an interesting stock. A lot of people saying Qualcomm behind in the AI race. Now they're finally rolling out this AI product, and apparently they've already sort of gotten whatever this big Saudi Arabia AI project is to actually buy in.
Right. It seems as though they've already gotten something lined up. But as you mentioned, a lot of people saw them as kind of behind the curve.
Yeah.
And so they're playing a little bit of catch up here is what people on Wall Street are saying here. And of course, we know that Qualcomm has really been the largest maker of smartphone operators, but we have been seeing them attempting to diversify there because they haven't been seeing the same sales that they used to. So you are seeing them really trying to carve out and pull into this space here and challenging the likes of NVIDIA.
Yeah, that's the interesting part. That, I mean, if you go for the full product here, that it could sort of displace NVIDIA. But then you take a look at NVIDIA's shares brushing off this news and then some, actually higher by about 2.4% right now.
Right. And if you look at Qualcomm year to date, I'm comparing it against the Philadelphia Semiconductor Index, that's SOXX. We've got the Philadelphia Semiconductor Index up about 41%, but we have Qualcomm trailing up 22% year to date. So when you kind of look at it in regards to its performance against a lot of its peers, it is still lagging a bit behind so far this year.
I do just want to point out, too, I mean, we had some other news coming out earlier today, this involving AMD and a partnership with the Department of Energy with regards to AI. And it gets to this idea of sort of these second-tier companies, for lack of a better phrase, because the AI trade, let's face it, it's been all NVIDIA, throw in the hyperscalers, and that's it, and then all the private companies out there. Are we finally starting to see more of a breakout into some of these second-tier companies that are maybe finally at least staking their claim to this AI space?
Right. You are seeing people really trying to stake their claim, some of these second-tier, quote-unquote, companies, as you're calling them here. I mean, we do have this $1 billion partnership that's being inked between AMD and the U.S., and we've seen the U.S. really taking on a lot of different partnerships. They're foreseeing this partnership with the U.S. and AMD here to focus on nuclear power, to cancer treatments, some preventative cancer treatments there, national security. So it is really a broad-based thing that they're really hoping to do here when they're building out these two supercomputers in this deal with AMD, but you are still seeing a lot of these names really trying to make a mark here in a space that is really occupied by the likes of NVIDIA.
We really need to find a nicer name than second tier.
Right,
because
the runners up.
Runners up, something like that. I mean, it does get at the idea that NVIDIA,
How about that?
something like that. But NVIDIA really has this incredible first mover advantage. And
I
I guess
watching Love is Blind last night for some reason.
Were you?
Really?
Well, my wife was watching it.
Okay.
Yeah, sure. That
makes more sense.
Speaking of bridesmaids and groups.
He was eavesdropping.
Yeah.
Sorry.
I don't know how to bring this back
There's no
to
segue
NVIDIA.
there.
Yeah, but I mean, we'll see. I guess that's the ultimate hope if you're an investor in AMD, or maybe if you're buying Qualcomm on this news, that maybe they'll be able to close the gap even a little bit with NVIDIA and that big first mover advantage that they have. Really appreciate your insights. That is Bloomberg's Norah, Mulinda.
Did you have a question about Love is Blind? I can answer that.
I didn't watch
I've
the
never
season.
watched it, Romaine.
Yeah.
You're actually
Love Island, that's where
The
I'm at
episode
right
was
now.
heartbreaking.
Really?
A lot of people got
Oh my
left at
God.
the altar.
You're going to have to tell me about it in the commercial break.
I
Don't
will.
cry.
I will.
Don't cry. All right, coming up next, we're going to take you to the closing bell with Stephen Dover, Chief Market Strategist over at Franklin Templeton, also the head of the Franklin Templeton Institute. That conversation coming up next. This is The Close on Bloomberg.
This is a investment cycle that still, to me, seems in early innings. I will say the magnitude of revisions to spending expectations that we've seen over the last couple of quarters has been, frankly, insane. And I think we're probably entering a period where the spending is going to continue to grow, but the surprised versus expectations, I think, compresses a little bit from here.
John Belton from the Gabelli Funds kicking us off to the close just about 50 minutes ago. And as far as insanity goes, how about this? Strongest three-day rally for stocks going back to mid-May.
Yeah.
Record highs across the board, Katie.
Yeah.
And we're at session highs right now.
It is just wild. It seems like that momentum building into the close on this Monday. The S&P 500 higher by 1.2%, led by technology. And we know it's a sort of make or break week when it comes to big tech. A whole bunch of your Magnificent Seven names going to report later in the week. The Russell 2000 not really getting in on the action in a really big way. Those small companies that populate the U.S. economy not seeing as much of the love.
I'm actually a little confused by this. I mean, you would think when you have this kind of risk-on type of sentiment with regards to trade and potential positive earnings and a rate cut that everybody says we're going to get on Wednesday, you would think some of those names in the Russell 2000 and even the mid-caps, you would get a little bit more of a traction.
Well, that's the thing, right? People build beautiful bull cases for the Russell 2000, and it never seems to reliably stick. And at least today, the color is green. Certainly, it's taken a beating in certain moments.
All right, a bit of a laggard here on the day as we move closer to the closing bells. Joining us right now is Stephen Dover, Chief Market Strategist at Franklin Templeton. He's also the head of the Franklin Templeton Institute. And Steve, I mean, there's been sort of three big themes coming into this week. Obviously, the busiest week for earnings, potentially some agreements when it comes to trade, and those Fed rate cuts. You combine all those together, Steve, I would assume that the risk-on appetite we have today probably has some legs beyond, does it not?
Yes, we think so. We're living in a situation, resilient global expansion, Fed easing into strength, not weakness. So yes, it's definitely a bull case. We did a study. We looked at the past 50 years, the 8 instances where the Fed cut after previously cutting. 100% of the time, 1 year later, the market was positive, averaging 17% for the S&P, 25% for the Russell, 20% for the Russell 2000, answering your small cap question, and emerging markets 27%. So we're very positive on the market going forward this next year, which really puts us into our 3 themes. We think, first of all, there will be broader equity participation, and we recommend that. Both in the U.S. and globally. We saw some of that over the weekend. A steepening yield curve, as you mentioned, as rates fall, and then more likely a softening dollar.
When we talk about this idea of the rates coming down, I mean, everyone's priced in that rate cut on Wednesday and most likely a third consecutive rate cut at the December 10th decision. Do you think, though, the Fed has the argument to make to continue cutting rates, meaning are economic conditions and the data that they say they depend on going to be supportive of 2, 3, 4 more cuts like the market is priced in for 2026?
We think that it's likely the case. I think you ask an interesting question because what the Fed should do and what the Fed is likely to do might be slightly different. So we probably wouldn't say the Fed necessarily needs to cut rates, but we would say the Fed is likely to certainly cut the next two and probably at least one into early next year.
Yeah, it certainly seems like that is the consensus. I do want to go around the world of asset classes right now, and I want to talk about gold because the action in gold over the past week has certainly been fascinating to watch. It's down another 3% today, so it felt like we twisted ourselves to explain the huge rally that we saw. Now we're trying to explain why we're seeing this big drawdown. Is this just a massive momentum buildup and now unwind?
In short, I think so. I think there's basic fundamentals for why gold went up. First of all, as you've discussed in your program many times, the increased buying of central banks, particularly China and Russia. And then secondly, kind of as a hedge. There isn't good evidence that gold was being bought as a hedge against inflation or even devaluation. So I think it's also gold is a measure of the global world's money supply, and the money supply is expanded. So gold kind of had to catch up with equity markets and everything else. So not surprised that gold got ahead of itself. It doesn't mean that gold isn't a good diversifier in this broadening market. Commodities are likely to do well, but you certainly don't want to catch that at the peak.
Yeah, the volatility in gold has been pretty stunning, which is not what you would expect from gold. Very unusual. I do want to talk about fixed income as well, because you point out in your notes that your bias right now is to remain short duration and high quality. And for a lot of folks, Stephen, it feels like that's been the playbook for a while. When would you feel comfortable going out when it comes to duration?
Yeah, so probably as we head into 2026 is the short answer to that. But what I really wanted to talk about is risk, because we're talking about equity and fixed income markets, and probably the place, at least for individual investors right now, to reduce risk and have good opportunities within fixed income is within municipal bonds, which hadn't performed very well this year so far because of an oversupply. This last September has been pretty good. So I think that in a world where we're very linked or hedged, if you will, towards AI, that's a good diversifier. Possibility other diversifiers might be real estate, both real estate debt and real estate literally, particularly maybe the industrials and life sciences area. And finally, as this market expands, private markets are going to expand. There's likely to be more mergers and acquisitions. There's likely to be more IPOs, so private markets might make sense as well.
Curious, Stephen, looking a little bit further into next year, do you actually structure your portfolio around the idea of higher inflation, or at least inflation maintaining where it's at now?
We would say maintaining where it is right now. We think that 50 basis points or perhaps more of that 3% inflation is due to tariffs. There's two sides of that. One is that tariffs haven't shown their way through the numbers, so that might keep inflation high for a little while. But secondly, the tariffs, as we even saw over this weekend, are actually lower than that kind of top stated that we thought they were going to be. So those will kind of eat their way through the system, and then inflation hopefully will drop a bit.
All right, Stephen Dover, Chief Market Strategist over at Franklin Templeton, helping us count you down to those closing bells. Those bells now less than 3 minutes away, with the S&P 500 at session highs, a record high with more than 300 names. Katie Greifeld in the green, led today by Qualcomm, an 11% jump.
Knocking on the door of 6,900. It seems like 7,000 for the S&P 500 is in reach, which is amazing when you consider how low we got in April, below 5,000. But fast forward to the end of October, it's pretty bullish.
We should point out, to the downside, we are seeing a lot of the material stocks get sold off, and that's actually potentially a positive. The idea that there is a potential trade deal between the U.S. and China, taking the bloom off the rose of some of those names, as we break down all of today's market action, starting now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Katie Greifeld, taking you through to that closing bell with a global simulcast. Carol Massar and Tim Stenovic join us from the radio booth. Welcome to our audiences across all of our Bloomberg platforms. Carol Massar,
yes,
completing our partnership with YouTube here on yet another record-setting day across the board here in the United States.
Kind of wild, right? And you just look at the last half hour or so, we've seen stocks move up to their highs of the session. This on a day where also, the momentum just building here into the close. It's a big week. Fed meeting, 5 of the Mag 7 reporting, U.S.-China trade talks. There's a lot coming out of investors. We'll see if the enthusiasm holds all week.
Apple, Meta Platforms, Microsoft, Alphabet, and Amazon. And Katie, I wonder if there will be questions on the call about the Reuters report about the layoffs that are happening, scheduled for tomorrow or set for tomorrow, according to Reuters, at Amazon HQ.
Have to imagine. So interesting to see not too much movement in the stock on the heels of that report that Amazon laying off 30,000 corporate workers, saying basically that they overhired, which is interesting because that was the narrative a couple years ago when it came to a lot of these big tech companies announcing their layoffs. But we had kind of gotten away from that, but certainly that narrative coming back with this Amazon report.
Yeah, and we should point out, I mean, this is going to be, of course, the busiest week for earnings of this season so far, and that includes today. We get some names that could have some consequence to the market, like NXP Semiconductor, Cadence, which is also in the semiconductor software space, Whirlpool, and a few others, including Avis Budget, too.
Yeah, got a day where we're seeing the VIX at just under 16, so a lot of complacency in the market environment on a day when we're going to probably see another record here from me.
Yeah, absolutely, and a lot of reasons to clap and cheer here on this Monday afternoon. Green across the screen for U.S. equities and record highs pretty much for everyone who wants one. The Dow Jones Industrial Average up more than 300 points or 0.7%. That's a record high. The S&P 500 up more than 80 points or 1.3% to a record high. The NASDAQ Composite and the NASDAQ 100 each up roughly about 1.8 to 1.9% to record highs. And look at this, the Russell 2000, which is your relative laggard on the day, it's only higher by about 7 points or 0.3%, 2520. If that holds, as we wait for these numbers to settle, that will be by less than 1 point a record high.
All right, folks, we already have some earnings crossing the Bloomberg terminal. Just quickly go to it. Avis Budget, third quarter revenue, slight beat, $3.5 billion. Street estimate was for $3.45 billion. And then just talking about third quarter America's per unit fleet costs down 20%. So basically revenue meeting estimates. Let me just see what else we got. Yeah. That looks like what we've got so far, and we're looking at the stock unchanged here in the aftermarket, so we'll keep an eye on it. Hey, S&P 500, let's go back there. Record on Wall Street, highs, finishing near our highs of the session. Katie, 322 names in the S&P 500 actually gaining ground today, 178 to the downside, 3 unchanged.
And certainly when you take a look at the sectors, you saw that strong breadth as well. 9 sectors in the green, that circle almost totally green. 2 sectors in the red. Communication services, big tech, consumer discretionary, those are some of your biggest gainers when it comes to the sectors. Consumer staples and materials, your lone 2 sectors in the red, really points to this risk-on appetite that enveloped this Monday session. As Romaine pointed out, materials being down could point to optimism over U.S.-China trade talks, and consumer staples lower on the day, being your biggest loser, certainly bullish as well.
All right, lots of green there. So let's get to some individual gainers. Got to talk about Qualcomm. Everybody talking about Qualcomm. Number 1 gainer in the S&P 500, NASDAQ 100 today, up as much as almost 22% intraday, finishing the day with a gain of 11%. Largest maker of smartphone processors, unveiling chips and computers for the lucrative AI data center market, and they really are looking to challenge NVIDIA in the fastest growing part of the industry. So that definitely caught investors' attention. We got some more earnings, Romaine.
Yeah, let's just hit Cadence since we're talking about chips, a big software design company used by a lot of the folks in the chip space here. EPS in the most recent quarter did beat $1.93. The street was looking for $1.79. Revenue in the most recent quarter also beat $1.34 billion. The street was looking for $1.32 billion. And more importantly here, we talk about the growth in this company, 10% revenue growth on the top line, the bottom line, decent growth there as well, about 17%, and a widening of the operating margins to about 47.6% here, though the shares are moving lower in the after-hours trade, and here's why. We're now taking a look at the guidance going forward for the full year. The company says it expects $5.26 to $5.29 billion. It had previously had a range of $5.21 to $5.27 billion. We'll try to get you some more details on this and try to explain why such a negative market reaction.
Let's quickly get over to Bed Bath & Beyond, also reporting earnings as well. You can see the stock is moving higher after hours. That is because when it comes to third quarter net revenue, that came in at $257.2 million. That is actually just shy of estimates, which had been for around $260 million. But then you take a look at the third quarter adjusted EBITDA loss. That came in at $4.94 million. The estimated loss had been for $10.5 million. So much better than expected when it comes to the expected loss, the third quarter adjusted EBITDA loss. You can see shares flying right now, Carol, now up 10% after hours.
Yeah, speaking of stocks flying in the aftermarket, I want to go back to Avis because that stock is up about 9% here in the aftermarket. So investors liking some of what we got from the company, specifically third quarter adjusted EBITDA, really surpassing Wall Street estimates. We're looking at $559 million, up 11% year over year. Estimate was for $538.7 million. So we're seeing some strong numbers from that company, and we're seeing it certainly move higher in the aftermarket. I'm going to go back to some individual gainers as we wait for some more earnings. Keurig Dr. Pepper, have to mention, up 7.6% at the close, among your top gainers in both the S&P and the NASDAQ 100. Keurig Dr. Pepper raising $7 billion from Apollo and KKR to help finance its acquisition of JDE Peet's MV. So you know the company's planning to separate its beverage and coffee businesses by the end of 2026. Also reported third quarter sales of $4.3 billion. And then Cadence Bank, just quickly, up 4.4% here in today's session. That after Huntington Bank shares agreed to buy the bank for $7.4 billion. So we continue to see consolidation, certainly, among the regional banks out there. All right, Tim, over to you.
Well, speaking of, go ahead.
Yeah, sorry, just there was some news crossing the wire right now. Carol, we talk about Citizens Bank, First Citizens, excuse me, and Park National Bank, a tie-up there. That headline just crossing the wire.
Well, every one of my movers to the downside this afternoon has to do with M&A or potential M&A here. I want to start with Newmont. Shares falling today. This is of course, the gold, copper, silver, zinc, and mining company. Down 5.7% on the day. Gold declined today, yes, down about 8.4% from those all-time highs earlier this month, but also Newmont is studying a potential deal to gain control of rival Barrick Mining's Nevada gold assets, that according to people with knowledge of the matter. Once again, shares down 5.7%. I know, Romaine, we got some more earnings.
Yeah, Whirlpool earnings out. The company reporting net sales that looks like coming in above expectations, about $4.03 billion. The street was looking for $3.93 ongoing EPS, basically on a continuing basis, $2.09 a share. The street on average is looking for about $1.40 per share here. The company also says that for the full year, it does see EPS of about $7 per share. It had previously provided guidance of $6 to $8 per share. So basically now hitting in the middle of that guidance, and the middle of that guidance at $7 a share is higher than the average of street estimates, which were looking for about $6.41. You see a 1% pop here, Tim, in the after-hours trade.
Yeah, I'm just looking through the press release, looking for commentary from Mark Bitzer, somebody who I know you guys have spoken to quite a bit. We've spoken to him as well. He said that the fundamentals of the business remain strong. They're confident that the newly announced investment in our U.S.-based laundry facilities will continue to fuel our future growth. Jim Peters, though, the CFO, saying that the third quarter results continue to be impacted by the inventory loading from Asia competitors, though they're focusing on what is within our control and delivered cost takeout in line with expectations, putting us on track to achieve approximately $200 million of cost takeout in 2025, Katie.
Yeah, really interested to see some of the details coming from that earnings call specifically. A lot of different angles in which Whirlpool is interesting, especially when it comes to consumer sentiment, but also when it comes to this company, how they're managing that inventory. I will say, you take a look at the shares down about 32% through the close year to date, and then over the 5-year basis down 52%. This is certainly a company that has had a rough go of it.
Yeah, and ahead of earnings, we saw more than 17% of the float short. So, you know, if there's some little signs of improvement, you might see some short covering and maybe explain some of the trade. But we'll keep an eye on it as it continues to bounce around, certainly in the aftermarket. But we have seen pop to the upside, 1.6% higher on Whirlpool. All right, guys, don't forget NXP Semi also coming out after the close a little bit later on today. That's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. Katie and Romaine continuing there on the close on BTV. And Tim and I continuing on Bloomberg Business Week Daily right here on Bloomberg Radio. We'll see you again, same time, same place tomorrow.
And keep an eye on the after-hours trade with names like Cadence, Nucor among your biggest decliners in the post-market to the upside. It's Avis, Confluent, and Arch also moving to the upside. We are still awaiting on those earnings out of NXP Semiconductor on a day where we saw chip stocks rally big. A conversation up ahead with Bernstein Research Stacy Rasgon after the bell. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostick. A record-setting day here on Wall Street once again for the S&P, for the Dow, for the NASDAQ, for the Russell 2000, and, well, even for biotechs. We haven't talked a whole lot about that as well. The NASDAQ Biotech Index as a group at its highest levels going back to 2021, and it really is a reflection here of a broader risk-on appetite that we've seen come into the market here on this Monday afternoon. A lot of that has to do not just with earnings and not so much with the Fed, but also some progress potentially on the trade front. It's a big part of the reason why you can continue to see a drop in the price of gold after that relentless trade tension-fueled rally over the past couple of months. And then, of course, soybeans actually having their biggest pop that we've seen in several months on the potential maybe that China returns to buying the U.S. product.
Yeah, we'll keep a close eye, of course, on the price of soybeans as we get closer to that meeting. But let's go back to the equity landscape. Some of the big movers on the day. A sea of green behind me. I wanted to highlight Keurig Dr. Pepper. We were talking about it a little bit earlier. Reporting earnings, but it's really that PE backing to help fund its acquisition of JDE Peets that seems to be helping out the stock today. AMD also having a good day just in the last hour or so, or few hours. Of course, we got the news about that $1 billion AI partnership with the one of the U.S. departments. You can see AMD shares up about 2.7%. But really, the story of today, the stock of today, is Qualcomm, higher by about 11%, and that's our top story this hour. Big moves in the chip space with the Philadelphia Semiconductor Index closing higher by more than 2% on the day. It was Qualcomm that led the index after the company announced plans to start shipping its new AI chip next year with the goal of challenging NVIDIA. Meanwhile, NVIDIA preparing to announce a $1.2 billion data center in Germany alongside Deutsche Telekom. This as investors look for a slew of tech and chip results this week, including NXP Semiconductors, which Romaine just crossed the wire.
That's right. Revenue in the most recent quarter actually down about 2.4%, $3.17 billion, which was relatively in line with what the street was looking for. EPS coming in at about $2.48 a share, also relatively in line with what the street was expecting here. But the guidance going forward, 4Q EPS, the company looking at a range of $2.40 to $2.81, and says that when you adjust that, look for $3.07 to $3.49. The street on average is looking for $3.30. The company also saying that gross margin in the most recent quarter, or in the current quarter, will be 57 to 58%, around what the street was looking for. You see the shares kind of bouncing between gains and losses. Remember, this is a relatively diversified chip maker, but it gets the majority of its revenue, more than 50% of that, from the automotive sector. Let's bring Stacy Rasgon into the conversation, senior analyst of U.S. Semiconductors over at Bernstein Research. Got a lot to talk about, Stacy, but let's start off with NXPI. What do you make of their earnings?
Yeah, it's pretty much in line, give or take, the quarter and the guide. The quarter was kind of in line on revenue, just a hair below on EPS, although it was a hair above guidance on EPS. The guidance is a little bit above on revenue. It's a little below on earnings. It looks to be mostly OPEX as far as I can tell. Gross margin guide looks in line. If you look at the segment results, again, auto was pretty much in line, industrial a little below, mobile a little above, but all in all, I mean, it's a pretty a boring quarter.
Yeah.
Relative to maybe, especially since what we've seen from some of the other peers.
Yeah.
This earnings season, yeah, it's mostly fine.
Well, is it boring because it's NXP, or is it boring just because everything that's going on outside of the analog chip space, which has caught everyone's attention?
Yeah, it's the latter. Like people have been, people who were hoping for much of this year to play like the analog recovery theme. We've been a little more lukewarm on that. And that's the thing, like most of these analog stocks are in recovery, quote unquote, like they're growing off the bottom, but it's definitely not V-shaped. It's much rounder. And we're kind of seeing that here with NXP as well, although I think maybe the expectations for them are a little bit lower. And like I said, versus where the street was, and I even think versus where sort of genuine buy-side expectations were into this print, this is pretty close. It's not fantastic. It's not awful. And again, you can see that the stock in the aftermarket just sort of bouncing up and down around flat.
Yeah, currently higher by about.
I'll take it. I'll take boring in this world lately.
All right, boring works for this environment. Let's talk a little bit about AI accelerators, because the big news out today was Qualcomm trying to break into that space, maybe eventually going to look to challenge NVIDIA here. We were talking about sort of these second-tier companies, if you want to call them that, trying to encroach on that moat that NVIDIA has built. Do you see that as something that's actually realistic and achievable?
Well, you got to remember, like, Qualcomm's actually sold into this market for 5 or 6 years. Like, it's just nobody really paid any attention to it. They've had what they call the AI 100, which I think was launched in 2019. And it was commercially available in 2021. They even did a refresh in 2023. So this looks to be the second-gen parts. These are rack-scale parts as well. We don't really know a lot. To be fair, there wasn't a whole lot in the press release in terms of performance or cost or content or anything like that. Do I really think they're going to compete like directly and do really well against what NVIDIA is delivering? Probably not. But for Qualcomm, does it matter? Like, not really. I don't think so. I mean, we've actually liked Qualcomm. I understand, people have been hesitant. They don't like smartphone stories. They've got a big Apple component, which is going away. Like, I understand all of that. But at the same time, the Apple headwind is very well known, and the diversification story is very real. And I felt like there's a lot of option value, of which data center and AI data center is one of them. And you got to think about it. It doesn't really matter. I don't almost care how big it is at this point. Like, what is it in the models? 0. What has it been in the multiple, at least through yesterday? 0, right? So whatever they can get out of this is upside. And, there's been plenty of other companies where the thesis has been it's a massive pie. Even if they just get a little bit, it's something. Like, why shouldn't the same sort of thing apply for Qualcomm as well?
Well, it's funny. You mentioned, there's not a lot of details here when you take a look at the press release, but Qualcomm shares certainly not waiting for that, just buying here and up 11% on the day. I do also want to get your thoughts on AMD. I know you wrote about this time last month, actually, that you were lukewarm on AMD. The news coming this afternoon that AMD and the U.S. Department of Energy are entering into a $1 billion AI partnership. Yeah. You think about this news the past couple of weeks when it comes to AMD. Are you a little bit warmer on this company?
Well, as we probably said a couple weeks ago, the setup actually doesn't look bad for them. I mean, the core end markets like PCs and servers are stronger now. I don't think the PC strength is sustainable. I think that's Windows end of life, but for now it's fine. Servers actually do look to be getting somewhat better, and Intel said they were supply constrained. So, I mean, AMD's already taking share, and so if there is excess demand, it's only got one way to go, which is AMD. And then on the AI side, you have to remember the last several quarters, the disappointing thing for AMD on their print has been that their AI numbers in the near term have been a little bit like lukewarm, lackluster, basically. At this point, and by the way, maybe this new DoD supercomputer will help in the near term, but it almost doesn't matter because what people are playing it for is the OpenAI ramp, which is massive potentially. It doesn't even happen for a year. So who cares what the AI number is in the near term? It almost doesn't matter. So yeah, I actually think this. We wrote this in our preview a week or two ago. I think the setup into the print actually looks pretty good for them.
All right, Stacy, great to get some time with you. That is Stacy Rasgon. He is Senior Analyst of U.S. Semiconductors over at Bernstein Research. NXP slightly higher after hours, but certainly it was a huge day for the semiconductor industry as a whole, Romaine.
Absolutely. Here we talk about how earnings, particularly tech earnings, are going to drive the trade this week, but so too is the Fed. A big decision on deck for Wednesday, a preview of what to expect. Darius Dale, founder and CEO of macro research firm 42 Macro. He joins us after the break. This is The Close on Bloomberg. All right, well, the Fed is scheduled to start its two-day meeting tomorrow. A big decision on Wednesday with the market pretty much pricing in fully a second straight cut in monetary policy. Of course, there are some broader questions about when the next cuts will come, if at all, and more importantly, who's going to be leading the Fed by the time we get to next year. A lot out there right now about the potential successors to Jay Powell, with Treasury Secretary Scott Bessent confirming the candidate pool now narrowed down to 5 finalists, and that includes Christopher Waller, Mickey Bowman, as well as a couple other folks there, including Kevin Hassett and Rick Reeder. Darius Dale joins us right now. He's the founder and CEO of macro research firm 42 Macro. And Darius, before we get to maybe who the next Fed chair is going to be, I am curious just about this sort of rate cutting cycle that we're on. And I don't know if we call it a cycle. It's only been, one cut. I mean, I guess we get the second one on Wednesday here. But I mean, you kind of point out the Fed, to a certain extent, structurally is kind of behind the curve.
Yeah, definitely. And thanks again for having me, Romaine. Appreciate you. Yes, in our view, the Fed is very much behind the curve with respect to its policy rate policy as well as its balance sheet policy. And that's having problems in the repo market, as we saw with some of these stress indicators that were triggered in the last couple of weeks. So it's our view, according to our models, that the Federal Reserve needs to accelerate the pace of returning the policy rate to a more neutral setting, as well as turning off this quantitative tightening program.
Well, I am curious with regards to quantitative tightening, that balance sheet, if you will, just sort of right-sizing that also help with regards to this idea of having looser monetary policy, meaning they can do this by not just cutting rates?
Yeah, well, it's a philosophical question, Romaine, and I think this is the big question of the time, because on one hand, the Fed is implementing monetary policy from a cyclical standpoint. The big challenge for investors to figure out with regards to 26 and beyond is, will the Fed Reserve be operating monetary policy from a structural framework? In our view, we think that the risk of them transitioning to a structural framework is actually quite high, because if you think about their too tight monetary policy and the impact that it's had on the economy over the last few years, essentially the Fed's reluctance to support this fiscal dominance regime has contributed to all sorts of adverse negative consequences from a K-shaped economy perspective in the economy. And so it's our view that one of those 5 people that you put up on the screen is going to have to lead the institution to structural regime change.
Yeah, it's going to be fascinating, of course, to see how that horse race actually shapes out. You take a look at reporting. It seems like Scott Bessent wants to get Donald Trump a list by Thanksgiving, and maybe we'll get a decision soon after that. But let's talk about, the leadership of the next Fed and what they'll be dealing with. Because you think about where we're headed when it comes to inflation. You haven't seen a lot of what we're talking about when it comes through with tariffs really show up in a meaningful way when it comes to the inflation data. Then you think about the labor market. You are starting to see some wobbles there. And certainly you think about some of the layoff announcements that we're getting from companies. Amazon just today, Reuters reporting. It seems like, again, the two sides of their mandate here could be in conflict. And I wonder how you're thinking through that, especially when it comes to how you put together a portfolio.
Oh, that's a fantastic question, Katie. And in our view, that we've been operating in this U-shaped economy framework, which gives the Fed a very robust window in which to ease monetary policy. They're getting a green light from the labor market and a green light from a structural regime change perspective to actually, bring this institution to the 21st century, if you will. And so it's our view, as it relates to constructing portfolios, you have to be maximum risk on at this juncture, because in our view, we think the Federal Reserve is going to go from, I would say, not understanding the impact that their balance sheet and their policy is having on the economy in terms of creating these K-shaped outcomes, to agreeing to understanding that and actually making changes. And in our view, that's incredibly bullish.
Maximum risk on, Darius. Explain to us a little bit more what that looks like when you get down to the sector level.
Yeah, that's a great question. So on the sector side of things, whenever you're max risk on, you want to be in high beta cyclicals from a factor risk perspective and a sector risk perspective. So obviously that's a continuation of what's been working. If you think about the technology sector, communication sector, the AI trade should work. The one thing I will say is, if you're an institutional investor, earmuffs if you're a retail investor, but if you're an institutional investor and you have to pick factors, there's likely to be a significant factor rotation at some point in the next, let's call it 3 to 6 months, as we transition from a weak economy that is, giving the Fed a window in which to ease monetary policy, to transitioning to an economy to a much more robust outlook. I'll throw one stat at you before I wrap up is, if you look at the median or the mean of the 2026 and 2027 real GDP growth estimates among Bloomberg consensus, your guys, the Wall Street consensus, it's 1.9%. In our opinion, that number is about 100 basis points too low. And so we think there's a significant positive revision cycle ahead of us still from this starting point.
All right, Darius, great to get some time with you. Hope to have you back soon. That is Darius Dale. He is founder and CEO of 42 Macro. Really interesting conversation. As we count down to that Fed decision, we didn't even get to the government shutdown with Darius, which is still ongoing. Another Monday that we're starting the week, and the government isn't open.
Yeah, it's like the elephant in the room that everybody's ignoring, but at least for right now, no real market impact when it comes to that. Obviously, something that Jay Powell will be asked about on Wednesday, assuming the government is still shut down, and how that factors in, not just the fact that he's not getting the data, but there are broader questions too, Katie Greifeld, just about the state of the economy. The idea that you have a certain cohort in the top income spectrum that's doing great, but everyone else maybe seeing a little bit more trouble.
Absolutely. And then you think about, where inflation is, where it's projected to go. And we didn't get to it with Darius, but whether or not 2%, is that really still the target, or have we quietly moved on?
And a lot of questions as to who the Fed is actually trying to help here. We're actually going to talk a little bit more here about what's going on in the broader economy, specifically through the lens of personal finance. Two of the leading economists on that subject are going to join us after the break. They've got a new book out, and they have some thoughts on how to fix it. This is The Close on Bloomberg. All right, with the big Fed meeting up ahead, the VIX hitting its lowest level in a month, and the stock market hitting record highs here, there's been a lot of talk here about the state of financial markets and, more importantly, the state of the economy. Although the market's fear gauge is muted, the impact on individuals' finances may not be. Our next guests are the co-authors of a new book called Fixed: Why Personal Finance is Broken and How to Make It Work for Everyone. They're two of the most prominent economic minds on this subject. John Campbell is professor of economics over at Harvard University, and Tarun Ramadorai is a professor of financial economics at the Imperial College London. Pleased to say both of them join us right now. Great to have both of you gentlemen here. I get sent a lot of books here. Most of them I don't read. When I saw your bylines on the bottom of the copy there, I had to know what you had to say. And I want to start off with you, John, because it seems like the narrative over the last few years has been about the broadening of the middle class. Yet at the same time, I see so many papers written, so much economic data that seems to suggest a middle class that, if not shrinking, at least is maybe not keeping pace with the upper classes. And I am curious as to why you think personal finance might be a contributor to that problem.
Well, thank you, Romain. It's great to be here. We absolutely think that personal finance contributes to the evolution of inequality of wealth in our country. And the reason basically is that richer people earn higher returns on their investments and pay less when they borrow. Now, some of that is inevitable. Small accounts are always going to be more expensive to operate. Wealthier people have collateral, they have houses and other assets against which they can borrow. But some of it, we feel, is due to the design of the financial system that is overly complex and actually encourages poorer and less educated people to make mistakes with their money that lowers the returns they can earn and causes them to fall behind wealthier people as they try to accumulate wealth over their lifetimes.
Well, Tarun, I mean, not to be cynical, but there are some people would say that that system might be intentional.
This is part of the reason that we wrote this book, which is that there's a feeling that the market system is going to, solve for these problems because the forces of competition should essentially reduce prices and increase quality for various things, including financial products. But our book makes the argument that because of the fact that we make decisions in a way that is sort of confused by our human biology, finance is hard after all. It's not something that we've sort of naturally evolved to do. That the system itself is competing over the wrong things. That is to say that the system is competing to give us products and services that we might want but may not need. And so part of our thesis in this book is that we need to find a way to fix this system, which seems to be operating with entirely the wrong incentives at the moment.
Well, Tarun, to draw that point out more, I mean, who fixes the system? Is this something that you can do on an individual level, or does this fall to governments, or does this fall to private companies? I mean, who goes about actually repairing some of these structures, if you will?
So, we are both finance professors. So in that sense, we are very strong believers in the market economy because, of course, it's the best system we know of that has generated sustained prosperity, and we believe will continue to do that. It's just that it feels like the guardrails of that system are not set appropriately at the moment. That's why we are in the situation that we are in at the moment. So a different way to put this is, we think that government and regulation should be there to provide the guardrails within which the capitalist innovation can flourish and financial products and services can return to their original purpose of delivering the highest possible quality, suiting people's needs at the lowest possible price.
And John, I do wonder, you mentioned investing and how, wealthier people have bigger accounts, and it's the smaller accounts that cost more to operate. So some of that is going to be the case. I think we lost John, so Tarun, the question comes back to you. How does personal investing come into the conversation that we're having about personal finance? For some, that's the same conversation. I wonder, though, if it is here.
I mean, I think we have both sides of this that we talk about. Of course, the household balance sheet has both an asset side and a liability side. Of course, it is true that personal investing is something that we encourage all people to do. I mean, an article of faith in finance, and for good reason, is that everybody should be participating in the stock market. It so happens, however, that if you participate in a way that kind of destroys wealth, you don't diversify appropriately, you don't pick the lowest cost index funds or mutual funds or any such funds, then you could end up actually squandering some of that earned wealth over the course of your lifetime. But it's also the liability side that we think about in this book, which is to say, if you don't have the right way of thinking about debt, if you pick the wrong mortgage, if you don't shop appropriately for that mortgage, if you're not very good at managing that mortgage by refinancing it on time, that can also be a real contributor to negative, returns on your wealth.
John, with regards to the solutions, though, I mean, when you look at, I mean, we talk about this idea of things being complex and maybe the system is set up that way, but we have seen a lot of efforts to kind of democratize finance, if you will. There are a lot of technological tools. There are a lot of new platforms out there like Robinhood and a few others that, in their own way, right or wrong, have tried to make things a little simpler. Does that not move the needle?
Well, we think financial technology is extraordinarily helpful and promising, and it's only just getting started. I think AI has tremendous applications in finance. The technology has made it possible to offer financial products at reasonable cost on a much smaller scale to poorer people with less money to invest. And it makes it possible to customize, it makes it easier to shop. So there are many advantages of technology, but unfortunately, technology can also be used to exploit people's biases. For example, to gamify trading, to encourage people to trade too much, to trade in a very speculative manner. It can be used to price discriminate. One of the most troubling things is that you leave a trail as you go around the internet, and this can be used to identify whether you're the kind of person who likes to shop or a person who's likely to take the first offer that's made to you, and products can be priced accordingly. So there are many ways in which technology can be used, but it can also be misused. And that's why we feel that some deliberate product design is needed to make sure that the products on offer are simple, easy to shop for.
I do want to
People can compare price and quality in a straightforward way.
I do just want to point out, too, John, and I know both of you obviously have worked for a long time in the U.S., but, I mean, growing up for myself, I mean, personal finance was not something that was really taught, certainly at the primary or high school level. I mean, once you got to college, if you took an elective, maybe. So you were basically just dependent on what you learned from your parents and your family. Have you seen any sort of meaningful shift, here in the United States at least, to sort of make finance and personal finance much more of a core curriculum much earlier in the student process?
Yes, there's a tremendous movement in this country to teach financial literacy in high school. I'm actually on the board of the Council for Economic Education, which is a nonprofit that promotes this effort. And more than half of U.S. states now do have a mandate that in order to graduate from high school, you should have studied some personal finance. We think this is an excellent effort, and it should be continued, and personal finance should also be taught in college. I teach more than 300 Harvard undergraduates personal finance at this moment. But we think this is insufficient in itself. There's a race, if you like, between financial literacy and the complexity of the system, and unfortunately, complexity has been winning the race, and we think we need to slow down that complexity, rethink product design, and bring it more in line with what people are actually capable of managing.
All right, well, that's a good place to leave it. Really appreciate you both taking the time today. That is John Campbell, economics professor over at Harvard University, as well as Tarun Ramadorai, financial economics professor at the Imperial College London, co-authors of the new book, Fixed: Why Personal Finance is Broken. Meanwhile, keeping the conversation going, retirees getting a boost in the face of rate cuts, with the Social Security Administration set to raise benefit payouts by 2.8% next year. Our next guest and her $9 billion retirement savings provider are fighting to reshape investing for retirement and help folks take better charge of their savings. PensionBee CEO Romi Savova joins us now. Romi, great to have you in person with us.
Thank you for having me.
So PensionBee is an interesting one, and I would love if you could just explain how the company operates and what you're trying to achieve. I know you were born out of sort of the friction that one encounters when trying to switch their retirement account when they move jobs, but how do you try to solve that problem?
Well, absolutely. That is one of the main problems in personal finance. The average person will have around 11 or 12 different jobs these days. And almost every time you get a new job, you might get a new retirement account, a 401k. And life gets busy, you move along, you go through your career, and when you're in your 40s or 50s, you might find yourself with lots of small little accounts just sort of littered all over the place. And so PensionBee helps consumers to take control of that money, to bring it together into one new online account, to have it invested in a way that is appropriate for retirement, really well diversified and focused on growth when you're younger, and then perhaps de-risking when you're older. So it works for your retirement.
Well, let's talk about what you actually invest in. When it comes to rolling everything into an IRA, I know that you invest in ETFs in particular, which I find interesting. I cover exchange-traded funds. They don't fit into 401ks, even though in a lot of cases, they're priced more cheaply than some of their peer mutual funds.
Absolutely. ETFs are very much the future of financial services. They're incredibly liquid, and we invest in ETFs like SPY and MDY, which are really well known for that level of liquidity. They're incredibly transparent. They can be traded pretty much instantly, and so your money doesn't sit out of the market, especially these days when markets are incredibly volatile. And so ETFs are really the future for retirement, and we think that they will eventually take over.
I am curious with some of the potential changes that could be coming here in the U.S. with regards to the types of assets that pension plans, that the individual folks in pension plans and in 401ks can invest in. Does that change what you have to do, and more importantly, what you have to do to educate people?
Well, the asset types that could sit within your retirement account are definitely broadening. And we've heard a lot about private assets in particular. These days, you can also access some of these private assets through ETFs. And so it might not change the operations entirely. I think that a good question, though, is this the right time to be putting private assets into retirement portfolios?
Is it?
And there are definitely some who would argue that it is.
Yeah.
It's a time when private assets are really growing relative to public markets. But it's also a time where private assets are seen as being at historical highs from a valuation perspective.
But what about from a diversification perspective? Because I mean, I'm old enough to know when you first get your 401k plan, it was pretty limited. I mean, you're basically just, you're buying a broad market equity fund of some type and maybe a broad market bond fund, and you might have an EM or something thrown in there as well, and that was it. And those options have expanded a lot, and probably for good reason.
Yeah, and diversification is absolutely still the free lunch that it's known to be within economic financial circles. I think we do have to ask ourselves, of course, what is the cost of these investments, and do they truly diversify the returns that you might receive in public markets? So I think the jury's still out on that.
The jury's still out. I do want to talk a little bit about your business specifically. I mean, when it comes to socializing this idea, when it comes to onboarding new clients, I mean, what does that look like?
Well, customers can sign up really easily for PensionBee. You can do it on our website, or you can download the app. And then you tell us a little bit about your old retirement accounts, sometimes as little as where you worked, and we can guide you towards the right record keeper where your money might be. We can then help you move that money over, and we can either do that through automations, or we can do that over the phone if that's how you prefer to work, or through live chat. It really depends on the individual's preference, because retirement can be a really complicated and scary subject, and sometimes you just need the human touch.
All right, so I really appreciate you coming on here. Romi Savova is the CEO over at PensionBee, a focus here on personal finance. We turn back, of course, to the AI trade and more breaking news in that space. An agreement, an extension of a partnership between Alphabet, Google, if you will, and NextEra Energy. NextEra popping about 1.5% here in the after hours trade here. Katie Greifeld, this is an extension of that partnership, a 25-year agreement right now for the Duane Arnold Energy project, which is a nuclear power project, presumably to power all of those data centers. This is out in Iowa.
Yeah, absolutely.
Yeah.
You can see the reaction muted right now. It seems like investors sorting through what exactly this means, some of the ramifications here. Let's get to some of the other notable movers in after hours trading, because we know it's a big earnings week. It's already started. Whirlpool now down slightly after reporting, had moved higher after that knee-jerk reaction, though. You can see Avis also a little bit higher. They had some numbers out earlier, up about 6%. Cadence Design Systems down slightly, and then a big move there when we come to
Confluent.
yeah, God, it's hard to read.
Yeah, I mean, both the big software firms in the AI, in the data center space, I should say here, are moving in opposite directions, and it gets back to that NextEra Google deal, and of course what we talked about a little bit earlier in the show with AMD and its partnership with the U.S. Energy Department. Everyone right now trying to secure some modicum of power to power this AI infrastructure build out.
Absolutely, and the chip sector squarely in the middle of that conversation. This is the close on Bloomberg. Well, UPS shares are down double digits over the last 3 months as the company prepares to deliver results tomorrow morning. Investors awaiting earnings guidance after the courier declined to offer an updated forecast in the last 2 quarters. Joining us to break down what to expect from those upcoming results, I'm pleased to say, is Lee Klaskow of Bloomberg Intelligence. So let's start on the guidance. Are we actually going to see an updated guide from UPS?
That's a great question. I think the good news for this print tomorrow morning is that expectations are relatively low. So that gives UPS a lot of room to maybe surprise on the upside. They're facing a lot of headwinds. I mean, they're expecting their consensus at least is expecting their adjusted earnings per share to be down around 25% in the third quarter, off of around 6% lower revenues. And that's really being driven on the volume side, because like any other transportation network, there's a deleveraging effect that happens when you have lower volumes. And the volume declines are expected more so in their domestic business versus their international business. And that is really being driven by the walking away or, reducing its exposure to Amazon, which is low margin business for them. And, while it's some short-term pain, will probably provide some long-term gain because they'll be able to fill their network with more profitable freight.
So I am curious, Lee, I mean, I guess I have a 2-part question. Do you think they are going to reinstate their guidance? But more importantly, what do you actually think they are going to have to say about the holiday season? I'm actually surprised. I know we're just starting the earnings season here, but we're basically at the end of October, and you have not heard a lot of chatter from companies in the retail, logistics, et cetera space talking about the holiday season yet.
Yeah, so on the guidance, FedEx reinstated their guidance when they reported, I guess, a month or so ago. It would be interesting to see if UPS does. The only way that UPS is going to do anything when it comes to guidance is really driven by their certainty. And their certainty, this is, I guess, a nice segue, will be like, how is the peak season shaping up? We've had some, mixed commentary from the companies we spoke to. Knight-Swift, which is a large truckload carrier, mentioned that they're seeing an uptick in project freight, which is really freight that goes for the holiday season, to levels that they haven't seen since 2021. So that's an incremental positive. But as many listeners in the show know, the kind of economy is almost like a K-shaped economy, where there are some consumers that are struggling and some consumers that are doing just fine. So I guess we don't really know where we're going to end up when it comes to shipping goods. And one of the headwinds that UPS is facing and FedEx and even DHL are facing is the reduction, or the elimination, I should say, of the de minimis exemption, which said that if freight was coming in from other countries, it was under $800, it didn't have to pay duties. Now it has to pay duties, and that really benefited some of the Chinese e-commerce companies.
All right, Lee Klaskow over at Bloomberg Intelligence. A nice roundup here of what to expect out of UPS. They're scheduled to report earnings before the bell tomorrow. The street's still looking for revenue in the most recent quarter of about $21 billion. And on the EPS side here, a little bit more softness in that space. But we're still talking about a company overall that, if you believe the average of analyst estimates, we're going to see a negative sign in terms of the growth rates on both of those metrics.
Absolutely.
Yeah.
And it doesn't seem like the street is suggesting that we're going to see any updated guidance from this company. I will say it's interesting to compare the stock price of UPS versus FedEx, of course, their peer and rival. Both are down year to date. Of course, it's been a really tough year for these two companies. Over the last 3 months, though, UPS down double digits, as I said. FedEx has actually managed to climb in that time, so a little bit of separation there.
I am curious, too, how they articulate how they're handling the tariff issues and being sort of the mediary, if you will, between whoever's shipping the product from overseas and the actual final customer, UPS obviously being sort of the middleman there. Because, I mean, I've had a couple of surprises where I've had things delivered, and when they show up, they're like, you owe us, another $90
That's
for
not a
the
nice
tariffs
surprise.
of things. And it's, but the problem is, like, who's responsible for doing that? You're putting it on the consumer? Because I don't check.
Yeah. Well, that's a lot of this tariff conversation, right? I mean, what gets passed on, these weird charges that you're getting, and a nice reminder from Lee about the expiration of those de minimis exemptions here. So it'll be interesting to see what kind of commentary we actually get out of the C-suite tomorrow morning.
All right, one of the companies reporting earnings tomorrow. We're going to set you up for the others that could move the market as well. Stick with us. This is The Close on Bloomberg. All right, let's set you up for what markets will have their eyes on over the next 24 hours. And includes earnings, including out of UPS, what we just talked about, but a few others as well.
Yeah, I am psyched when you look at just the embarrassment of riches we have there. Royal Caribbean, United Health, that's before the market, PayPal too. Then you take a look after hours, we got Visa, EA, Booking, Caesars Entertainment, and Mondelez. So a real swath of industries.
And I always love this time of the year because we get a nice cross-section here of, I guess, the economy, if you will. We do get some economic data, private data from the Conference Board, consumer confidence. But 12 p.m. Eastern time in Washington, something interesting is happening.
Yeah, NVIDIA, the CEO Jensen Huang, he will be delivering a keynote address. So we'll see, of course, what is actually delivered there. And I have to imagine it will move markets.
And this is a big deal. This is the big GPU conference they normally have out west. He's moving it to D.C. for this time.
Says something.
Wonder why. Balance of Power up next.